want to bring you someone that you want to listen to. He is Tom DeMark. He created the DeMark indicators. He's a very widely followed market strategist, market timer. He advises George Soros, Leon Cooperman, Steve Cohen, among others. Tom, great to have you on the show. You called the bottom so far this year. You called the top so far this year. Where are we now?
Well, the market is really right now in a holding pattern. It was pretty definitive at the May 2nd high, just as it was definitive at the August 9th and the October 4th lows. And off the October 4th low, if you recall, we were projecting upside 1188 on the futures market, the S&P futures December, and we were projecting 1194, possibly as early as 3 to 4 days. What happened, I said if it would occur within 3 to 4 days, it would probably be spurred on by short covering, and as a result, there'd be a vacuum under the market, and the market could turn sharply lower afterwards. Fortunately, it took 4 days, but we did accomplish that very quickly, and as a result, it extended the upside potential in the market, and we were projecting as high as 1246 on the S&P futures and 1254 to 1257 on the S&P cash. Well, that's happened 10 days ago, 11 days ago, and in the meantime, this past Tuesday morning, we received an alert when the market moved below 1188 on the futures overnight and the Globex trading, which was just below our level, and it moved below 1194 on the cash in early morning trading, and that gave us an indication that the market could move up very quickly, another 5.5% by the end of this week. And what the market did do was move to 1230. The day before yesterday, and there was a failure at that point. So now we're uncertain. We're uncertain as to the direction of the market. We're waiting.
Key, Tom. That's key, and forgive me for interrupting, but because I know that a couple of days ago there was a report out that you thought we'd go to 1250. We haven't done that. And then you thought we'd go to 1250 and then trade off. Does the action of yesterday and today sort of make you question that premise? Do you think we actually go down first before going up?
It very well could be. The concern we have right now is the market should have followed through after that big move 2 days ago, and it failed. And because it failed, it made us a little uncertain about the near-term direction. And because of that uncertainty, we looked very carefully at the market today. If the market had exceeded on a closing basis the S&P futures 1240, and in particular the 121710, they're both indicators we use. One is trend factor and one is relative retracement. We probably would have tomorrow moved immediately to the upside to the 1246 to 1250 area on the futures and 1254, 1257 on the cash. See, two things have occurred. Last Friday, we exceeded both those levels. And all that was required was the following trading day's open, which was Monday, to confirm it by opening higher, which it failed to do. If you recall, Monday, the market moved sharply lower.
So
then on Tuesday,
let me ask you, Tom, to make it simple, because I know you and I could talk about this stuff for probably 3 days, but for some of the viewers who don't have the benefit of talking for 3 days, given that we didn't see the move that you thought we'd have, and now we seem to be kind of weakening, how much lower could we go from here?
Well, see, like I said, it's happened 2 times. The attempt last Friday was not confirmed on Monday. The attempt on Tuesday was not confirmed on Wednesday. Today was another opportunity, and the market not only failed. Friday and Tuesday, the market did show strength because it closed above those key levels, but failed to follow through the next day. Today, we struggled and didn't even get to the levels. That's a concern. So near term, I'd say the market is in a stationary trading range, but I'm concerned we may go down for a period of time and then reset itself and then attempt to break those levels.
Now, is there any risk, Tom, that we break that 1076 bottom that we put in a couple of weeks ago, a bottom which you called? It's been the low of the year. Any chance we go back and retest that?
Not at this time. Markets won't turn down. After the move we had, currently we had a 190-point move almost that I was expecting. It was really a 170-point move in the S&Ps in a matter of 12 days, almost unprecedented. When you get that much movement to the upside, it takes a while to dissipate. So worst case, we go down maybe 40 points and then try again. But it's disconcerting, the fact that the market had 3 attempts those last 3 days, and as a result, I mean, this past 4 or 5 trading days, and none of the times did it prove itself that it had the vigor to move higher. So it's unfortunate, and this is what happens.
Yeah, and you know, you've also given us a roadmap. You've said we've sort of been here before. I want to bring this up for the benefit of the viewers. You make the comparison between back in 07 and 08. That's on the top of the chart, all right? And some of those numbers correspond to specific aspects of market timing. I won't get into it, but it's part of your math. And then you look beneath that, and the number of days match up. It's 33 days, 72 days, 70 days, 109. Well, there was that rally that you had that took time back in 07, 08. Look at what happened right beneath that chart. We got the whole rally in just 2 weeks, which is what you've been talking about. Does that give you cause for pause, the fact that the market went up so fast?
It really
and
does.
Now
Yeah. It spent itself very quickly. If you look at that comparison off the October 11th high in 2007, which is the all-time high, and then the decline into March 11th, you see it encompassed 109 trading days. That's identical to the May 2nd to October 4th move to the downside. Exactly 109 days, and you could even see the market wrinkles. Those rallies, those short-term rallies coincided almost one for one. The first decline of the 2007 to March 2008 decline encompassed what was 20%, 21% decline. It was almost identical into the recent low on October 4th, 22% almost. And now the subsequent rally, which took 44 days for the market to peak out in May of 2008, it's only been 10 days, 12 trading days. And usually what happens, if the market moves too quickly, like I said, it's short covering, and it is indicative of a long-term downtrend. If you remember in the past, we've had discussions on May 2nd, we had a coincidence of what we call the combo and sequential indicators. They all spoke on a monthly, weekly, and daily basis. They all produced 13s exactly the day and the week of May 2nd. And at the August 9th low, combo and sequential only spoke with one voice, and that was a daily 13. The weekly and monthly are still in a down mode. So we're really operating against the trend.
It sounds, Tom, like for the people that you're advising, they should be playing more for a short bias, more of a move down because we haven't gotten the move up. Is that a fair statement?
Well, yes, I think if the market were to go to 1246 to 1254, depending upon to 1257, depending upon whether it's the S&P December futures or cash, yes, the market would move sideways and probably would resume its decline immediately. There would be an extended period of sideways movement, and then the decline would be resolved, the market would be resolved to the downside. The fact right now that we're having trouble here would have the implication of a more immediate turnaround to the downside. And that's where we're starting to move in that direction. We're getting concerned. Because usually the game plan that we defined isn't changed. Off the May 2nd high, we didn't know when the low would be 1076, but we knew it would eventually occur. Just like off the 1076 low, the 1188 looked within our sight in a matter of 4 days, and it occurred in 5 days. Now this 1250 area we were looking for at the end of this week. Now, what could occur at market tops, we find that there's coincidence of good news. And there is the foreign, the EU ministers are meeting this weekend, and they could surprise everyone, and we could get that thrust to that level. But that's indicative of a market top and a bear market. Good news usually occurs at market tops. Bad news occurs at market bottoms. And that's all in line with our belief that markets make tops when the last buyer is bought, and markets make bottoms when the last seller is sold. So that whole theory is there in place.
Okay, Tom DeMark. When I hear Tom DeMark talk about market tops and the word concern, I take note, and I hope our viewers do. Tom, thanks for joining us. We'll check in with you as we like to every couple of weeks and see how this thing evolves. Thanks for joining us, Tom. When we come back, we're going to look